market right now is down, what did you say, 2% already this morning? Yeah. Market's down 2% right after the jobs report came out that they added almost 2 million jobs. That's pretty positive economic news, puts unemployment below 9%, yet the market's going down. What's up with that?
Yeah, let me see what the high was. All right, let's get the high. I guess I could have just looked at the 52-week high. That would have been a smart thing to do.
The 5-day high.
Yeah.
So for the S&P, the 52-week high was 3,588, and that was on last Wednesday, September 2nd. And now it's at 3,380. And we have more positive economic news and more positive news on COVID too.
Yeah.
The vaccines are all kind of going through trials right now, and it seems like we have positive testing on the vaccines.
The only negative thing I saw was that Fauci said he thought cases were a little high going into Labor Day, and he thought that would be concerning. But all the other vaccine news should outweigh that, you would think. So
is the market just reacting to what Fauci says and ignoring everything else?
Seems like he has a lot of influence on the market right now.
Yeah. I mean, and a lot of people.
It's concentrated in those tech stocks, though, right?
Yesterday's drop, that is today the same way.
I'll look that up. Y'all continue discussing.
Yeah, because like he just said, yesterday's drop was mainly tech stocks. That was the bulk of the drop. It was Apple and Tesla and somebody else, I don't remember. So, but what's funny is, does that have anything to do with coronavirus? Like tech stocks, really? I don't know.
I don't know. It's so far from reality. It seems like, I don't know. It's hard to reason anymore, to be completely honest with you. Dallas, I'd be curious what you got to say about it.
Yeah. So I think a lot of it is I mean, obviously it's not driven by economics, right? That's why it's just so confusing. So it has to be driven just by the average investor or putting their money in. So they're using the indices. They're using, hey, let's just buy the big names, right? And we hit that new all-time high 2 days ago, and now everyone's worried. Let's jump out. Like I think it's all just, the market reaction is to the new all-time high, and that fear of being at an all-time high, and what to do next. I was actually talking to a client, I think it was yesterday. We were in the meeting, and she said, so what do we do when we think the market's gonna crash? Do you pull everything out? And we had to stop and be like, no, like that's not the way any of this works. Like, you just stay in and ride it.
So what's the benefit of staying in and riding it?
So what I told them was, the economy, we think about the economy, it goes in an upward trajectory. Like, we expect our economy to grow this year, or maybe not this specific year, but the current year you're in over the previous year. That's the standard expectation, right? And so the stock market follows that trend of, we expect things to grow, and that's why we get even stuff like inflation or all those different economic drivers, just because we're constantly expanding. We can go into why that is, and there's tons of theories on that too. But that, so in a perfectly functioning economy, you're always at an all-time high. You should always be at an all-time high. It's not normal to be coming back. Does that make sense?
That's a good point. So if so there's going to be there's really two schools of thought, right, on investing. Buy and hold through the down, and then try and actively manage and try and time the highs and the lows, get in and out of the market, right? In which case, I think the three of us kind of like the latter, right? Just our former.
So in my personal accounts, I buy index funds and then I'll overweight stocks that are inside those funds. But they're all what I consider a long-term hold over a year, usually 2 years or so. And then I do have a little fun pot where I buy some options and lose money that way. But I guess that's the active side. But for my real investments, I'm mostly an indexer.
I would agree. I'm the exact same.
Do you do any overweights with individual stocks?
Not really. Like you, I have a small account that I like to, do some trading in. But, as far as that's maybe 5% of my overall, wealth. I'm not going crazy on the day trading over there. So.
And for me, so I use my accounts versus my wife's accounts. So Megan's accounts are in pass, they're 70-30, they're pretty vanilla. And then with mine, I've told you guys, I'm like all large cap growth, which has been awesome in 2020. But
it's been awesome from 2010 to 2020.
which that's a whole other topic we could talk about.
Yeah, for sure.
But in looking at that, like I recognize that I'm 100% in one area concentrated, and I recognize that one day I could take a huge hit, but at the same time, that's why I have Megan so conservative, so that mine can be risky.
There you go.
So, okay, you're concentrated, but are you concentrating are you actively managing that concentration, or is it like, I'm going to assume your concentration is large cap growth. Did you just say that?
It's growth, but yeah, I think it's 50% large cap growth, and then mid cap and small cap is another 50.
So is your plan to be in that large cap growth section forever, or is it like you're going to move it as you see?
Good question. So no, I guess it's more long term. I'm not trying to time it. I'm just looking at it and saying, hey, the trend over the last 10 years has been growth leading the way. So I'm not going to try and overthink it. I'm just going to put in what's been winning. So I recognize that is what's it called? A behavioral thing, like hot hand theory or whatever, but I don't care.
Well, but you also have to consider your household portfolio is more diversified than just yours. You said it yourself. Megan is more on the small and value side, and more diversified probably throughout, but really more focused on small values. So you're just kind of going over there to sort of balance that out. So
That's a good point.
makes sense.